There is an invisible thief in your life. It doesn't break down your door or shatter your windows. It doesn't announce itself with a siren or a shout. It operates in silence, in the background hum of the global economy, and it is systematically stealing the future you are working so hard to build. This thief is called inflation, and its work is so subtle, so gradual, that most people don't even realize they are being robbed until it's far too late. They see the numbers in their bank account, the balance of their 401k, and they feel a sense of security. But that security is an illusion, a mirage created by a failure to understand the difference between numbers and value. The number of dollars you have is a meaningless vanity metric if each of those dollars buys less and less with every passing year. That $100,000 you've diligently saved for retirement might still be $100,000 in 10 years, but it may only buy what $50,000 buys today. You have been robbed of half your wealth without a single dollar ever leaving your account. This is the silent, devastating crime that happens every single day to the vast majority of people. They work, they save, they follow the conventional rules of personal finance, and yet they find themselves running faster and faster just to stay in the same place. They are trapped on a financial treadmill, one that is controlled by central banks and geopolitical forces far beyond their control. They feel the squeeze at the grocery store, at the gas pump, in their utility bills, but they mistake these for temporary problems, failing to recognize them as symptoms of a chronic disease eroding their financial health. The common response to this threat is as predictable as it is ineffective. Some, paralyzed by fear, hoard cash. They believe the safest place for their money is in a savings account, earning a microscopic interest rate that is dwarfed by the real rate of inflation. They are guaranteeing a loss every single year, choosing the certainty of slow financial decay over the perceived uncertainty of the markets. Others, seeking yield, chase after stocks with high dividend payments, often in industries like utilities or telecommunications. They are drawn in by the promise of a steady income check, but they fail to see the capital-intensive trap they are walking into. They buy businesses that are like giant, hungry beasts, requiring constant, massive infusions of cash just to maintain their operations, especially as inflation drives up the cost of every pipe, every cable, and every tower they need to build. They are picking up pennies in front of a steamroller. And then there are those who flee to the old havens: gold, commodities, real estate. They are buying hard assets, which feels tangible and safe. But these assets produce no cash flow. They are sterile. Their value is based entirely on the hope that someone else will pay more for them in the future. They are instruments of speculation, not investment. But there is another path. A path pioneered and perfected by a man who has watched decades of economic cycles, a man who has not just survived inflation, but has used its very presence to build one of the greatest fortunes in human history. Warren Buffett's approach to this invisible thief is not defensive. It is offensive. He doesn't hide from inflation, he harnesses it. He has identified a very specific type of business that acts as a financial arc in an inflationary flood. These businesses don't just protect your purchasing power, they enhance it. They possess two secret ingredients that turn the corrosive force of inflation into a powerful tailwind for growth. The first is the ability to raise prices without fear of losing customers, a concept known as pricing power. The second is the ability to grow and generate more profit without having to spend enormous amounts of money on new buildings, machines, or infrastructure. The magic of a capital-light business model. By understanding these two principles, you can stop being a victim of inflation and start becoming its beneficiary. You can build a portfolio that doesn't just survive the storm but sails faster because of the wind. This is not about complex financial instruments or risky speculation. It is about a fundamental shift in how you view a business. A shift from seeing a company as a collection of assets to seeing it as a system for generating cash. It is about learning to distinguish the businesses that are slaves to inflation from the businesses that are its masters. This is the final promise, that by the end of our journey today, you will possess the mental framework to build an inflation-proof portfolio, to protect your wealth from the silent thief, and to secure a financial future that is measured not in nominal dollars but in true, enduring purchasing power. The first step in this journey is to truly understand the enemy. We must confront the sheer destructive force of inflation, not as an abstract economic concept, but as a tangible threat to our lives. The years between the late 1960s and the early 1980s in the United States serve as a stark, chilling history lesson. It was an era that began with optimism and ended in economic despair, an era that branded the term stagflation, the toxic combination of stagnant economic growth and high inflation, into the national consciousness. To understand Buffett's genius, we must first walk through the wreckage that this period created. In the late 1960s, the market was gripped by a mania for a group of stocks known as the Nifty 50. These were the blue-chip champions of their day, companies like Coca-Cola, IBM, McDonald's, and Xerox. They were seen as one-decision stocks. You bought them, put them away in a drawer, and waited to get rich. The belief was that their growth was so certain, their quality so high, that no price was too high to pay. Investors, both institutional and retail, piled in, driving their valuations to astronomical levels. It was a market fueled by post-war optimism and a belief in the perpetual growth of American corporate power. But beneath the surface, the seeds of decay were being sown. The costs of the Vietnam War and Lyndon B. Johnson's Great Society programs were putting immense strain on the U.S. budget. To finance it all without raising taxes, the government essentially printed money, debasing the currency. In August of 1971, the situation reached a breaking point. President Richard Nixon, in a move that became known as the Nixon shock, unilaterally severed the U.S. dollar's final link to gold, ending the Bretton Woods system that had governed international finance since World War II. The world's currencies were now floating freely, and the primary anchor against inflation was gone. The result was a decade of monetary chaos. The price of oil quadrupled following the 1973 oil embargo. The cost of living skyrocketed. An inflation rate that had been a placid 1 or 2% for years suddenly surged, hitting over 6% in 1970, dropping briefly, then rocketing to over 11% in 1974, and eventually peaking at a staggering 13.5% in 1980. For investors, the carnage was unimaginable. That Nifty 50 portfolio, the collection of can't-miss stocks, was annihilated. From its peak in 1972 to its trough in 1974, the Dow Jones Industrial Average lost nearly 45% of its value. But that's the nominal loss. In real inflation-adjusted terms, the collapse was far worse. A stock like Xerox, a titan of technology, fell from a high of $170 per share to just $27. IBM, the most dominant company on the planet, saw its stock go nowhere for nearly a decade. If you had invested $1 in the U.S. stock market at the beginning of 1973, by the end of 1974, after accounting for inflation, your dollar was worth less than 50 cents. Imagine working your entire life, saving diligently, investing in the best and safest American companies, only to see half of your life's work evaporate in 2 years. This wasn't a failure of capitalism, it was a failure of understanding the destructive power of inflation. While this was happening, Warren Buffett was in a unique position. He had famously closed his investment partnership in 1969, telling his partners that he felt out of step with the speculative mania of the market and could no longer find investments that met his standards. He returned their capital and consolidated his own wealth primarily into Berkshire Hathaway, at that time a struggling textile mill, and a company called Diversified Retailing. He was watching the carnage from the sidelines, not as a fund manager, but as a private investor, trying to preserve and grow his own capital in one of the most hostile environments imaginable. He saw firsthand how inflation acted as a, quote, giant corporate tapeworm, eating away at profits before they could ever reach shareholders. He saw how even good businesses struggled when their costs were rising relentlessly, and they lacked the power to pass those costs on to their customers. This period was his laboratory. It was here, in the crucible of the 1970s stagflation, that he solidified the core principles that would guide his investment strategy for the next 50 years. He learned that the most important question you could ask about a business was not how much it would grow, but how much capital it would need to consume to achieve that growth, and whether it had the power to reprice its product to match the debasement of the currency it was operating in. The Nifty 50 taught him that a great business can be a terrible investment if you pay too high a price. The 1970s taught him that most businesses, even seemingly stable ones, are terrible investments at any price in an inflationary world. This painful history is the foundation upon which his inflation-proof philosophy was built. The reason so many people were blindsided by the stagflation of the 1970s and why so many are being victimized by inflation today can be traced to a fundamental flaw in human cognition, a cognitive bias known as the money illusion. At its core, the money illusion is our tendency to think of currency in nominal terms rather than real terms. We anchor on the number printed on the bill, the digit displayed on our bank statement, rather than on the actual purchasing power that number represents. It's a mental shortcut that, in a stable monetary environment, is harmless. But in an inflationary environment, it is financially fatal. Our brains are not naturally equipped to perform constant, real-time calculations of inflation-adjusted value. When you receive a 3% raise at work, your brain registers it as a win. You have more money. The nominal number has gone up. But if inflation that year is running at 5%, you haven't received a raise at all. You've received a 2% pay cut. Your purchasing power has declined. You are poorer than you were before, despite the larger number on your paycheck. The money illusion makes you feel richer, while the reality is the opposite. This bias is exploited, both intentionally and unintentionally, by the systems around us. Governments report economic growth in nominal GDP, often masking an underlying weakness in real per capita terms. Companies boast about record revenues, even if those revenues are purely the result of price increases and not of selling more goods or services. The financial media flashes headlines about the Dow Jones crossing a new 1,000-point threshold, a purely nominal milestone that says nothing about the real, inflation-adjusted value of the companies within it. We are swimming in a sea of nominal numbers that create a distorted picture of reality. This is compounded by another powerful psychological trap, normalcy bias. This is the human tendency to believe that the future will look very much like the recent past. For the generation of investors who came of age in the 1990s and 2000s, an era of relatively low and stable inflation was the norm. The idea of a 1970s-style inflationary spiral seemed like a relic of a bygone era, something you read about in history books. This belief makes people complacent. They structure their financial lives, their mortgages, their savings plans, their retirement assumptions, based on the assumption that low inflation will continue indefinitely. When the environment shifts abruptly, as it has recently, they are psychologically unprepared. They dismiss rising prices as transitory, a temporary blip, because the alternative, that a fundamental shift is underway, is too disruptive to their worldview. Normalcy bias prevents them from taking the necessary defensive actions until the damage is already done. Buffett's mind operates on a different plane. He actively fights the money illusion by always thinking in terms of real after-inflation returns. He understands that a bond yielding 4% when inflation is 6% is not an investment. It is a confiscation certificate, guaranteed to transfer 2% of your wealth to the government each year. He pierces through normalcy bias by studying economic history, knowing that periods of monetary stability are the exception, not the rule, in the long arc of human history. His entire investment philosophy is designed to counteract these biases. He seeks businesses whose value is not tied to the nominal value of the dollar, but to their enduring ability to command a share of the consumer's wallet, regardless of what that wallet is denominated in. He is buying a stream of future purchasing power, not a stream of future dollars. Overcoming these deep-seated cognitive biases is the first and most critical step in building a truly resilient investment portfolio. To break free from the money illusion, you must translate the abstract threat of inflation into a concrete, personal reality. The official Consumer Price Index, or CPI, is a useful but flawed metric. It's an average calculated on a basket of goods and services that may or may not reflect your actual spending habits. To truly understand how the invisible thief is robbing you, you must calculate your own personal inflation rate. This is a powerful mental model that transforms you from a passive recipient of economic data into an active analyst of your own financial life. The process is simple, but the insights it provides are profound. First, you must become a financial archaeologist. Your mission is to dig into your financial records from the previous year. This means gathering your bank statements, your credit card statements, and any budgeting apps you use. Your goal is to categorize every dollar you spent into broad buckets. The key categories will likely be housing, rent or mortgage payments, property taxes, insurance, transportation, gas, car payments, maintenance, public transport, food, groceries, dining out, healthcare, insurance premiums, co-pays, prescriptions, utilities, electricity, gas, water, internet, and discretionary, entertainment, travel, shopping. The more granular you can be, the better, but these core categories will capture the bulk of your spending. Total up the amount you spent in each category for the entire year. The second step is to become a diligent tracker in the present. For the current year, you must meticulously track your spending in those exact same categories. This requires discipline. You can use a dedicated budgeting app, a simple spreadsheet, or even a notebook. Every time you buy groceries, pay an electricity bill, or fill up your car, you record that expense in the appropriate category. The goal is to build a direct, apples-to-apples comparison to your spending from the previous year. After a full 12 months of tracking, you perform the calculation. For each category, you take this year's total spending and divide it by last year's total spending. Subtract 1, and then multiply by 100. This gives you the percentage increase or your personal inflation rate for that specific category. You might find that your transportation costs are up 15% because of gas prices, while your healthcare costs are up 8%. Your food bill might be up 12%. You can then create a weighted average based on what percentage of your total budget each category represents. If housing is 40% of your budget and it only went up by 3%, while food is 15% of your budget and it went up by 12%, you can calculate a far more accurate picture of how rising prices are impacting your specific financial situation. The result of this exercise is a single powerful number, your personal inflation rate. This number is your new benchmark. It is the hurdle rate that every single one of your investments must clear just for you to break even in terms of purchasing power. It rips away the veil of the money illusion. A 7% return on your stock portfolio doesn't feel so great when you know your personal inflation rate is 9%. A 3% interest rate on your savings account is revealed for what it is, a guaranteed 6% loss. This mental model grounds your financial decision-making in reality. It forces you to confront the urgency of the problem and pushes you to seek out investments that can deliver a real return, not just a nominal one. It becomes the foundational number in your entire approach to personal finance, asset allocation, and wealth preservation. It is the first step in thinking like Buffett, not in dollars, but in what those dollars can buy. The path taken by the vast majority of people, the 99% who see their wealth silently erode over time, is a path paved with good intentions and flawed logic. It is the path of the cash hoarder and the dividend chaser. Let's first examine the psychology of the cash hoarder. This individual is typically risk-averse, often having been burned by a market crash in the past, like the dot-com bust of 2000 or the financial crisis of 2008. Their primary financial motivation is no longer growth, but the avoidance of loss. The volatility of the stock market feels like a casino, a chaotic and unpredictable place where fortunes can be wiped out overnight. In contrast, the balance in their savings account feels solid, real, and safe. The number never goes down, except when they withdraw from it. This provides a powerful sense of psychological comfort. They see their $100,000 in a certificate of deposit yielding 2% as a safe investment because their principal is protected. They fail to see that in a world with 5% inflation, their principal is not protected at all. They are losing 3% of their purchasing power every single year, guaranteed. The bank is paying them $2,000 in interest, but the cost of living has increased by $5,000. They have suffered a $3,000 net loss in what their money can actually buy. They have chosen the illusion of safety over the reality of wealth preservation. They are like a person trying to shelter from a flood by standing in a slowly rising river, mistaking the lack of waves for safety, all while the water level creeps inexorably higher. Then there is the dividend chaser. This investor is a little more sophisticated. They understand that holding cash is a losing game. Their goal is to generate income from their portfolio. They are drawn to stocks that offer high dividend yields, often in sectors like utilities, telecommunications, or real estate investment trusts. On the surface, the logic seems sound. A stock yielding 5% provides an income stream that appears to beat inflation. But this is a dangerous oversimplification that ignores the underlying business economics. Many high-yield companies operate in capital-intensive industries. An electric utility, for example, must constantly spend billions of dollars on power plants, transmission lines, and maintenance. A telecom company must spend billions on cell towers and fiber optic cable. When inflation hits, the costs of these capital expenditures skyrocket. The price of steel, copper, and labor all increase dramatically. The company is now caught in a vicious squeeze. It has to spend more and more money just to maintain its existing service, leaving less and less cash available for dividends or growth. If the company operates in a regulated industry, like a utility, it can't even raise prices to offset these costs without getting permission from a government commission, a slow and uncertain process. The dividend chaser focused only on the yield fails to see that the business's foundation is crumbling. They are collecting their 5% dividend while the underlying value of the business stagnates or declines. Eventually, the pressure becomes too great, and the company is forced to cut the dividend, at which point the stock price collapses, dealing the investor a devastating double blow of lost income and lost capital. Both the cash hoarder and the dividend chaser are victims of a narrow focus. They fixate on one variable, principal safety or dividend yield, while ignoring the much larger and more destructive force of inflation working against them. They are playing checkers on a chessboard, making tactical moves that fail to account for the strategic reality of the game. The true cost of ignoring inflation isn't just a few percentage points here or there. It is the difference between financial security and a future of constant financial struggle. Let's quantify this impact using a simple but powerful mathematical tool, the Rule of 72. The Rule of 72 is a quick way to estimate how long it will take for something to double, or, in this case, for your money's purchasing power to be cut in half. You simply divide 72 by the rate of inflation. Let's say inflation averages a seemingly modest 3% per year, a rate many economists would consider normal. Using the Rule of 72, we divide 72 by 3, which gives us 24. This means that at a 3% inflation rate, the value of your cash, the purchasing power of every dollar you have saved, will be cut in half in 24 years. A 25-year-old diligently saving for retirement will find that by the time they are 49, every dollar they saved in their youth has lost half its value. Now let's consider a more aggressive inflationary environment, say an average of 6%. We divide 72 by 6, and the answer is 12. In just 12 years, your purchasing power is halved. A 40-year-old planning for retirement at 65 would see the value of their savings cut in half not once, but twice, before they even stop working. Their nest egg would be worth only a quarter of what they thought they had. Let's apply this to a concrete financial scenario. Imagine 3 individuals, each starting with a portfolio of $100,000. The first is our cash hoarder. They keep their money in a savings account earning 1% interest. The second is an index fund investor, whose portfolio grows at a nominal rate of 8% per year. The third is a follower of the Buffett philosophy, who has constructed a portfolio of inflation-proof businesses that also grows at a nominal rate of 8%. Now let's introduce an annual inflation rate of 4%. After 1 year, the cash hoarder's account balance reads $101,000. But because of inflation, their purchasing power has decreased by 4%. Their real inflation-adjusted return is -3%. Their $101,000 now only buys what $97,000 would have bought a year ago. They have lost wealth. The index fund investor's portfolio grows to $108,000. After subtracting the 4% inflation tax, their real return is 4%. Their wealth has grown in real terms to $104,000. This is the conventional path to success. But the Buffett-style investor has a hidden advantage. Their portfolio is not just growing, it is composed of businesses that directly benefit from inflation. Let's say that their specific collection of businesses, due to their immense pricing power, are able to increase their earnings not just by 8%, but by 8% plus the rate of inflation. Their earnings grow by 12%. Their portfolio grows to $112,000. After subtracting the 4% inflation tax, their real return is a staggering 8%. Their wealth has grown in real terms to $112,000, even after accounting for the loss of purchasing power. The difference seems small in year one, $97,000 versus $104,000 versus $112,000. But compound this over 30 years. The cash hoarder's purchasing power will have been utterly decimated, reduced to a fraction of its original worth. The index fund investor will have built a respectable sum, achieving a modest level of financial freedom. But the Buffett-style investor will have created generational wealth. The gap between them won't be linear. It will be exponential. This is the direct financial connection. Understanding inflation and positioning your portfolio correctly is not a minor optimization. It is the single most important strategic decision you will make for your long-term financial health. It is the foundation upon which all successful long-term investing and wealth preservation strategies are built. The first pillar of Warren Buffett's inflation-fighting fortress is a concept so powerful yet so simple that it's often overlooked: pricing power. Pricing power is the ability of a business to raise its prices over time to offset rising costs without losing significant business to its competitors. It is, in Buffett's own words, the single most important factor in evaluating a business. A company with strong pricing power owns a piece of its customer's mind. It has a product or service so desirable, so essential, or so unique that customers will grumble, but they will ultimately pay the higher price. This is the ultimate economic moat. There is no better story to illustrate this principle in action than Buffett's acquisition of See's Candies in 1972. At the time, Buffett and his partner Charlie Munger were looking for businesses to acquire with the cash being generated by Berkshire Hathaway's insurance operations. They were introduced to the See family, who were looking to sell their California-based chocolate company. The numbers were straightforward. See's was earning about $4 million a year before taxes, and the family was asking for $30 million. Buffett, still heavily influenced by his mentor Benjamin Graham's cigar butt approach of buying statistically cheap companies, balked at the price. Paying a multiple of more than 7 times pre-tax earnings for a simple candy company seemed expensive. It was a good business, but it wasn't a statistical bargain. It was Charlie Munger who pushed Buffett to see the bigger picture. Munger understood that they weren't just buying factories and inventory. They were buying a brand. They were buying a half-century of happy memories associated with birthdays, anniversaries, and holidays. See's Candies held a special place in the hearts of its customers, particularly on the West Coast. When a man needed to buy a box of chocolates for his wife on Valentine's Day, he didn't comparison shop for the cheapest option. He went to See's because it was the trusted, quality brand. That emotional connection gave the company a power that didn't show up on its balance sheet. Buffett and Munger ultimately agreed to buy the company for $25 million. What they discovered over the subsequent years was the true magic of pricing power. Inflation was raging through the 1970s. The cost of sugar, cocoa, labor, and transportation was constantly increasing. For a normal candy company, this would have been a disaster, crushing their profit margins. But See's was not a normal company. Every year, after Christmas, the management would slightly increase the price per pound of their chocolates. And every year, the customers came back. They might have noticed the price increase, but their loyalty to the brand and the emotional significance of the gift trumped any price sensitivity. The desire to give a quality, trusted product was inelastic. This small, annual price increase had a dramatic effect on the company's financials. Because the volume of candy sold didn't change much, almost the entire price increase dropped straight to the bottom line as pure profit. The initial $4 million in pre-tax earnings grew and grew. Over the years since the acquisition, See's Candies has generated over $2 billion in pre-tax profit for Berkshire Hathaway, all while requiring very little additional capital investment. That $25 million purchase has returned its initial cost 80 times over. See's became the prototype for the kind of business Buffett would hunt for from that point forward. It was a business with a deep, defensible moat built on a brand, one that gave it the power to dictate prices rather than accept them. It taught him that it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The gusher of cash produced by this small candy company would go on to fund Berkshire's other acquisitions, from the Buffalo News to Coca-Cola. It was the financial engine, powered by pricing power, that helped build the foundation of the modern Berkshire Hathaway empire. It was the quintessential example of a business that could turn the headwind of inflation into a tailwind of ever-increasing profits. The phenomenon that allowed a simple candy company to become a financial powerhouse can be explained by a powerful combination of behavioral psychology and microeconomics. At its heart, the pricing power of a company like See's Candies is rooted in the deep-seated human need for trust and the avoidance of social risk. This is the psychology of brand loyalty. A brand is not a logo or a slogan, it is a mental shortcut. In a world of overwhelming choice, a trusted brand reduces complexity and provides a guarantee of quality. When you buy a product from a brand you trust, you are outsourcing the cognitive load of research and comparison. You are buying certainty. For See's, that brand was built over decades. Customers knew that a box of See's chocolates would be fresh, delicious, and consistent. This consistency built a powerful habit loop. But it goes deeper than that. For a product often given as a gift, there is a significant social risk involved. If a man gives his wife a cheap, off-brand box of chocolates for their anniversary, and it tastes terrible, he hasn't just saved a few dollars, he has failed in a social ritual. He looks cheap and thoughtless. The small amount of money saved is not worth the potential for embarrassment or disapproval. By purchasing the trusted premium brand, See's, he is insuring himself against this social risk. He is signaling care and good taste. This psychological dynamic makes the customer remarkably insensitive to small price increases. The cost of switching to an unknown, cheaper alternative is not measured in dollars, but in potential emotional and social fallout. This leads directly to the economic concept of price inelasticity of demand. In simple terms, demand for a product is inelastic, when a change in price has a relatively small effect on the quantity of the product that is demanded. If a company raises its price by 10% and its sales volume only drops by 1%, its demand is highly inelastic. This is the holy grail for any business. Companies that sell commodities, like generic wheat or basic steel, face perfectly elastic demand. If they raise their price by even a fraction of a cent above the market rate, their customers will instantly switch to a competitor, and their sales will drop to zero. They are price takers. But companies with strong brands, patented technology, or high customer switching costs create inelasticity. Think of Apple's iPhone. Apple can raise the price of its new models each year, and while some people may complain, the vast majority of its user base remains locked into its ecosystem of apps, software, and interconnected devices. The cost and hassle of switching to an Android phone, transferring data, learning a new operating system, losing iMessage are too high for most. This is a powerful switching cost moat. Microsoft enjoys a similar position with its Windows operating system in the corporate world. An entire organization's workflow is built around Microsoft products. The cost to retrain thousands of employees on a new system would be astronomical, so they pay the annual licensing fees without question. Buffett understood this on an intuitive level. He realized that the brand of See's Candies acted just like a patent or a high switching cost. It created a powerful psychological lock-in with its customers, which in turn created the economic condition of inelastic demand. This allowed the company to systematically raise prices to counteract inflation and expand its margins, turning a simple product into an extraordinary financial machine. So, how can you, as an investor or an entrepreneur, systematically identify businesses that possess this incredible pricing power? The mental model you need to apply is what I call the customer outrage test. It's a simple thought experiment that cuts through the noise of financial reports and gets to the heart of a company's relationship with its customers. It's a qualitative tool, not a quantitative one, but it is incredibly effective for making a first-pass judgment on the strength of a company's economic moat. The process involves 4 steps. Step 1 is to clearly identify the company's core product or service. Be specific. For Starbucks, it's not just coffee. It's the consistent experience of a premium, customized coffee beverage in a specific environment. For Google, it's not just information. It's the dominant search engine that provides highly relevant results instantly. Step 2 is the core of the thought experiment. Imagine that tomorrow morning, the company announces a 10% price increase across the board. A grande latte at Starbucks now costs 10% more. The cost per click for advertisers on Google goes up by 10%. The subscription fee for Netflix increases by 10%. Step 3 is to honestly and critically ask yourself, what would the customer reaction be? Would there be mass outrage? Would customers immediately start searching for alternatives? Or would they grumble for a day on social media and then, for the most part, continue to pay the higher price? This is the critical juncture. If your immediate thought is that a 10% price hike would cause a mass exodus of customers, the company has little to no pricing power. It is likely in a highly competitive, commoditized business. But if you believe that most customers would reluctantly absorb the cost, then you are looking at a business with a potentially powerful moat. Step 4 is the most important. You must analyze why time the customers would stay. This is where you identify the source of the pricing power. Is it a powerful brand, like Coca-Cola or Nike, where the product is intertwined with the customer's identity? Is it a high switching cost, like with your bank, where the hassle of moving direct deposits and automatic payments is too great to justify changing over a small fee increase? Is it a network effect, like with Facebook or LinkedIn, where the value of the service increases as more users join, making it impossible for a new competitor to gain a foothold? Or is it a regulatory advantage, like a patent on a life-saving drug, or a government-granted monopoly for a utility service? A truly great business will often have multiple sources of pricing power. Apple has a powerful brand, high switching costs due to its ecosystem, and a network effect in its App Store. Moody's, the credit rating agency that Buffett loves, benefits from a regulatory-endorsed duopoly and a brand built on a century of trust. By applying the customer outrage test, you force yourself to think like a customer, not just an investor. You move beyond the numbers on a spreadsheet and analyze the qualitative, human factors that truly drive long-term business success. This mental model is your primary filter in the stock-picking process, allowing you to quickly discard the weak and focus your deep-dive analysis on the truly exceptional businesses. The opposite of investing in a business with pricing power is falling into the commodity business trap, which is the path followed by 99% of investors and entrepreneurs. A commodity business is one where the product or service is largely undifferentiated from its competitors. The only factor that matters to the customer is price. Think of an airline selling a seat from New York to Chicago. To the average leisure traveler, a seat on American Airlines is functionally identical to a seat on United or Delta. They will almost always choose the cheapest option. This forces the airlines into brutal price wars, constantly undercutting each other to fill their planes. The same is true for a wheat farmer, a steel mill, a generic drug manufacturer, or a gasoline station. They are price takers, completely at the mercy of the market. During periods of economic stability, these businesses can survive, often operating on razor-thin profit margins. But when inflation takes hold, their business model collapses. Let's trace the chain of destruction for a hypothetical commodity business, a small, independent textile mill. The mill buys raw cotton, spins it into yarn, and sells it to clothing manufacturers. In a normal environment, let's say they make a 5% net profit margin. Now, an inflationary shock hits the economy. The price of their primary input, cotton, skyrockets by 20% due to a bad harvest and increased global demand. Their energy costs to run the looms jump by 30%. Their labor costs increase by 10% as workers demand higher wages to keep up with the cost of living. The mill's total costs have now increased by, say, 15%. To maintain their 5% profit margin, they would need to raise the price of their yarn by 15%, but they can't. Their customers, the clothing manufacturers, are also in a competitive business and will simply buy their yarn from a cheaper supplier in another country. The mill has zero pricing power. They are forced to absorb almost all of the cost increases. Their 5% profit margin instantly evaporates. They are now operating at a loss. They might try to cut costs, but there's little fat to trim. They are trapped. They can either continue to operate at a loss, burning through their cash reserves, or they can shut down. This is the fate of the vast majority of businesses in an inflationary world. Investors who buy into these companies are making a critical error. They often get lured in when the stock price looks cheap on a metric like price to earnings or price to book value. They see a company trading at a P/E ratio of 8 and think it's a bargain, failing to realize that the E, earnings, is about to disappear. They are buying a melting ice cube. They are picking up a cigar butt off the street, just as Buffett did in his early days, hoping for one last free puff. But instead they find that the cigar butt is soaked in gasoline. The commodity business trap is a graveyard for capital. It demonstrates why Buffett's focus on pricing power is not just a preference, it is a survival mechanism. Without it, a business is a ship with no rudder in an economic storm, tossed about by the waves of inflation until it inevitably crashes against the rocks. The financial difference between a business with pricing power and a commodity business is not subtle, it is a chasm that becomes starkly visible on the company's income statement. Let's create a simplified financial model for two companies, both of which start with identical financials. Company A is our Toll Booth Inc., a business with a powerful economic moat and strong pricing power. Company B is Commodity Corp., a business in a highly competitive, price-sensitive industry. In year one, both companies have $100 million in revenue. Their cost of goods sold, COGS, which includes raw materials and labor, is $60 million. This gives both companies a gross profit of $40 million and a gross margin of 40%. Now, let's introduce a 10% inflationary shock. The input costs for both companies, materials, labor, energy, increase by 10%. Their COGS rises from $60 million to $66 million. Here is where their paths diverge dramatically. Toll Booth Inc., because of its strong pricing power, is able to pass this cost increase directly on to its customers. It raises its prices by 10%. Its revenue, therefore, increases from $100 million to $110 million. Now, let's look at its new income statement. Revenue is $110 million. COGS is $66 million. The new gross profit is $44 million. $110 million, $66 million. What's fascinating is that its gross margin percentage remains exactly the same. $44 million divided by $110 million is still 40%. But the key takeaway is that its absolute dollar profit has increased from $40 million to $44 million. The company has not only protected itself from inflation, it has actually become more profitable in nominal terms, perfectly preserving the purchasing power of its earnings. Now look at the fate of Commodity Corp. Its costs have also increased by 10%, so its COGS is now $66 million. However, due to the intense competition in its industry, It has no pricing power. It cannot raise its prices. Its revenue remains stuck at $100 million. Let's look at its new income statement. Revenue is $100 million. COGS is $66 million. Its new gross profit has plummeted to $34 million, $100 million, $66 million. Its gross margin has been crushed, falling from 40% to just 34%, $34 million per $100 million. Its absolute dollar profit has collapsed by 15%, from $40 million to $34 million. And this is before we even account for the fact that each of those $34 million is now worth 10% less due to inflation. In real, purchasing power terms, the company's profitability has been devastated. This simple example is the financial engine of Buffett's entire philosophy. It shows how pricing power directly translates into financial resilience and growing profits, while a lack of it leads to margin compression and financial ruin. An investor holding Tollbooth Inc. sees their share of the earnings pie grow, protecting their wealth. An investor in Commodity Corp sees their share of the pie shrink dramatically, a direct hit to the value of their investment. This is the tangible, quantifiable financial advantage that separates the masters of capital from its victims. The second, equally critical pillar of Buffett's inflation-proof strategy is his focus on capital-light businesses. If pricing power is the shield that deflects the attacks of rising costs, the asset-light business model is the nimble footing that allows a company to dance around the dangers of inflation altogether. A capital-light business is one that can grow its sales and profits without needing to constantly reinvest huge sums of money into physical assets like factories, machinery, or real estate. To understand the genesis of this insight, we have to go back to one of the most audacious and brilliant investments of Buffett's early career, the American Express salad oil scandal. In 1963, American Express was a respected, blue-chip company, known primarily for its travelers' checks. However, it had a lesser-known division that provided warehousing services. One of its biggest clients was the Allied Crude Vegetable Oil Refining Corporation, run by a charismatic fraudster named Tino DeAngelis. DeAngelis had taken out massive loans from Wall Street banks, secured by his supposed inventory of salad oil stored in American Express's warehouses. The problem was, the inventory was a phantom. The tanks were mostly filled with seawater, with only a thin layer of oil floating on top to deceive inspectors. When the fraud was discovered, Allied Crude collapsed, defaulting on loans worth what would be over $1.5 billion in today's money. Since American Express had certified the inventory, it was held liable. Wall Street panicked. The consensus was that American Express would be wiped out by the claims. Its stock price was eviscerated, falling by nearly 50% in a matter of weeks. While others were panicking, the young Warren Buffett saw an opportunity. He didn't just look at the headlines, he dug into the fundamentals of the business. He recognized that the warehousing division, while the source of the scandal, was an insignificant part of American Express's true value. The real business, the crown jewel, was the traveler's check and credit card operation. And this business, he realized, was a masterpiece of capital-light economics. Think about what it takes to grow a traveler's check business. You don't need to build giant factories or buy expensive machinery. The primary asset is trust. Customers would give American Express their cash, and in return, they would receive pieces of paper, the traveler's checks. American Express could then hold this cash, known as float, and invest it for its own profit until the customer eventually cashed the check. The business was built on intangible assets: the brand name, the global acceptance network, and the trust of millions of customers. To confirm his thesis, Buffett went out and did his scuttlebutt research. He visited restaurants and banks, he talked to merchants and customers. He wanted to see if the scandal had damaged the core brand. Had people stopped using their American Express cards? Had merchants stopped accepting them? The answer was a resounding no. The public correctly saw the scandal as an isolated incident, and their trust in the core financial products was unshaken. Convinced that the market was irrationally punishing the entire company for the failure of a minor division, Buffett made an enormous bet. He invested $13 million, representing 40% of his investment partnership's entire capital, into American Express stock. It was the single largest investment he had ever made. The market soon came to its senses, the scandal faded, and the stock price roared back. Buffett's partnership made a fortune. The salad oil scandal taught Buffett a profound lesson. The most valuable assets of a business are often the ones you can't see or touch. A business built on intangible assets like brand, reputation, and network effects can be far more resilient and profitable than one built on physical assets, because it can grow without consuming vast amounts of capital, making it a perfect vehicle for navigating an inflationary world. The market's hysterical overreaction to the salad oil scandal was driven by a deep-seated cognitive bias, the tangibility bias. Humans are neurologically wired to place more value on things we can physically see and touch. For our ancestors surviving on the savannah, a tangible asset like a tool, a shelter, or a store of food was directly linked to survival. An intangible concept like reputation was abstract and secondary. This ancient wiring persists in modern financial markets. Investors and executives are naturally impressed by tangible assets. A company that announces the construction of a massive new billion-dollar factory or a gleaming new corporate headquarters seems powerful and successful. The physical manifestation of investment creates a powerful illusion of progress and permanence. Conversely, we tend to underweight the value of intangible assets. The brand equity of Coca-Cola, built over a century of advertising, doesn't appear on its balance sheet. The network effect of Facebook, which makes the platform indispensable to its billions of users, is not listed as a line item. The proprietary algorithm of Google, arguably one of the most valuable assets on the planet, has a book value of 0. This bias leads to a fundamental mispricing of businesses. The market consistently undervalues companies rich in intangible assets and overvalues companies that are heavy with physical ones. Executives, driven by the desire to demonstrate progress to their boards and shareholders, fall into the trap of empire building. They pursue growth through acquisition and massive capital expenditure projects because these activities are visible and easy to measure. They mistake the accumulation of assets for the creation of value. A CEO who builds 10 new factories looks more successful than a CEO who refines a piece of software, even if the software generates a far higher return on investment. Buffett's genius lies in his ability to completely invert this thinking. He learned to look past the tangible assets and focus solely on the cash-generating power of a business, regardless of its source. He understood that a factory is not an asset. It is a liability. It is a machine for consuming capital. It requires constant maintenance, upgrades, and eventual replacement. The real asset is the customer loyalty, the pricing power, and the operational leverage that allows a business to generate cash flow far in excess of its tangible asset base. By overcoming the tangibility bias, Buffett was able to identify companies like American Express, See's Candies, and later Coca-Cola and Apple as businesses whose true worth was hidden from plain sight, locked away in their intangible, capital-light economics. This counterintuitive approach is a cornerstone of his ability to find wonderful businesses that the rest of the market misunderstands and misprices. To translate this powerful concept into a practical tool for your own investment analysis, you can use a mental model called the growth-to-capex ratio. This is a simple back-of-the-envelope calculation that instantly reveals whether a business is capital-light or a capital-intensive treadmill. It helps you quantify the asset-light advantage. The process requires you to look at a company's financial statements, specifically the income statement and the cash flow statement, over a 5 or 10-year period to smooth out any single-year anomalies. First, you need to calculate the company's revenue growth in absolute dollar terms. Look at the revenue figure from 5 years ago and the revenue figure from the most recent year. Subtract the old number from the new number. For example, if a company's revenue grew from $500 million to $800 million over 5 years, its absolute revenue growth is $300 million. Second, you need to find the total amount of money the company spent on capital expenditures, or CapEx, over that same 5-year period. You will find this line item on the cash flow statement. CapEx represents the money the company spends on acquiring or upgrading its physical assets like property, plants, and equipment, PP&E. Add up the CapEx figure for each of the 5 years to get a total. Let's say our example company spent a total of $30 million on CapEx over those 5 years. The final step is to create the ratio. Divide the total revenue growth by the total CapEx. In our example, we divide $300 million in revenue growth by $30 million in CapEx. The result is a ratio of 10-to-1. This means that for every $1 the company spent on physical assets, it was able to generate $10 in new annual revenue. This is the sign of an incredibly efficient, capital-light business. It's a business that can grow without consuming itself. Now let's contrast this with a capital-intensive business, like an auto manufacturer. It might also have grown its revenue by $300 million over 5 years. But when you look at its cash flow statements, you might find that it had to spend $250 million in CapEx, retooling factories, developing new models, building new plants, to achieve that growth. Its growth-to-CapEx ratio is $300 million divided by $250 million, which is just 1.2-to-1. For every dollar it spent on assets, it only generated $1.20 in new revenue. This is a business on a treadmill. It has to run as fast as it can, pouring all of its cash back into the business, just to stand still. By applying this simple ratio, you can quickly sort companies into 2 piles: the capital-light cash gushers and the capital-intensive cash incinerators. This is not a perfect metric, but it is an incredibly powerful first filter. It provides a numerical anchor for the qualitative concept of an asset-light business model and helps you focus your research on the types of companies that are most likely to thrive, especially in an inflationary environment where the cost of that CapEx is constantly rising. The antithesis of Buffett's approach is the seductive but ultimately destructive path of the empire builder's folly. This is the path followed by the 99% of executives and investors who are mesmerized by growth for growth's sake and equate size with success. The empire builder CEO is driven by a desire to preside over a sprawling enterprise. Their language is filled with metaphors of conquest and construction. They talk about expanding our footprint, building new capacity, and making landmark acquisitions. Their annual reports are filled with glossy pictures of new factories, giant cargo ships, and sprawling corporate campuses. They are celebrated on the covers of business magazines as visionaries who are aggressively growing their companies. Investors, suffering from the same tangibility bias, reward this behavior. They see the growing asset base on the balance sheet and mistake it for growing value. They cheer on the ever-increasing revenue numbers, failing to ask the critical question, at what cost did that revenue growth come? The airline industry is the poster child for the empire builder's folly. It is a business that is structurally designed to destroy capital. To grow, an airline has only one option. It must buy more airplanes. A modern commercial jetliner costs hundreds of millions of dollars. It is an incredibly expensive, rapidly depreciating asset. The moment it flies off the lot, its value starts to decline. It requires constant, costly maintenance. Its fuel costs are massive and volatile. Its labor costs are high and unionized. For an airline to grow its revenue by, say, 5%, it must increase its capital base by a similar or even greater percentage. It is a business with a growth-to-CapEx ratio that is often less than 1. Over the entire history of the airline industry, the net cumulative profit for all U.S. carriers is less than 0. It is a machine that has consumed more capital than it has ever produced for its shareholders. Yet, investors repeatedly pour money into it, lured by the cyclical upswings and the tangible appeal of these magnificent flying machines. During an inflationary period, this flawed business model goes from being bad to being catastrophic. The cost of a new airplane from Boeing or Airbus skyrockets. The price of jet fuel, one of their largest expenses, can double or triple. The unions demand significant wage increases to keep up with the cost of living. The airline is squeezed from every direction. And because the industry is so brutally competitive, they have very little pricing power to offset these rising costs. They are trapped in a capital-intensive nightmare. The empire builder CEO, committed to his growth strategy, continues to order new planes and expand routes, borrowing more and more money to do so. They are accelerating on a treadmill that is tilted ever more steeply against them. This folly is not limited to airlines. It applies to most manufacturing, heavy industry, and utility companies. They are all engaged in a constant battle against depreciation and obsolescence, forced to pour every dollar of profit back into the business just to maintain their competitive position. Investors who are seduced by their apparent size and industry importance are making a critical mistake. They are confusing the symbols of industrial might with the substance of economic value. They are investing in capital incinerators, ensuring that their portfolio will be a primary victim of the inflationary fire. The true financial impact of a capital-light versus a capital-intensive business model is most clearly revealed through the lens of a crucial metric, return on invested capital, or ROIC. ROIC is the ultimate measure of a company's profitability and efficiency. It answers the question, for every dollar that is invested in this business, how many cents of profit does it generate each year? A high ROIC is the fingerprint of a wonderful business. Let's see how this plays out. A capital-light business, like Moody's or See's Candies, might have $1 billion of capital invested in its operations. This includes both debt and equity. Because of its high margins and low capital needs, it might generate $300 million in annual operating profit. Its ROIC would be 30%, $300 million profit, $1 billion capital. This means the business is a phenomenal compounding machine. It can take its profits and reinvest them back into the business at an incredibly high rate of return, creating a virtuous cycle of growth. Now consider a capital-intensive business, like a utility or an automaker. It might have $50 billion of capital invested in its sprawling network of plants and equipment. To generate a profit, it has to overcome the massive costs of maintaining and depreciating this asset base. It might generate $4 billion in annual operating profit. Its ROIC would be 8%, $4 billion profit, $50 billion capital. An 8% return is not terrible, but it's barely above the company's cost of capital, the cost of borrowing money, and satisfying equity investors. It is not a compounding machine. It is a slow-plodding workhorse. Here's why this matters so much for long-term wealth creation. A company that can consistently generate a 30% ROIC can essentially double its intrinsic value every 2 to 3 years through internal compounding alone. A company earning an 8% ROIC would take nearly a decade to do the same. This difference, compounded over 10, 20, or 30 years, leads to an astronomical divergence in shareholder value. The stock price of the high ROIC company will grow exponentially, while the stock of the low ROIC company will likely just track the broader economy, or worse. During an inflationary period, the situation for the low ROIC capital-intensive company gets even worse. The I in the ROIC formula, the invested capital, gets inflated. The replacement cost of its factories and machines skyrockets, so now its denominator is getting bigger, while its numerator, the profit, is getting squeezed by rising costs. Its ROIC collapses, often falling below its cost of capital, meaning the company is actively destroying value with every dollar it reinvests. The capital-light business, in contrast, is largely immune to this. Its invested capital base is small, so the replacement cost is negligible. Its profits, protected by pricing power, are growing. Its ROIC remains high and robust. This is the direct financial connection. A focus on capital-light businesses is not just an abstract preference. It is a strategy to harness the power of compounding by investing in companies that can generate high returns on their capital, a task that becomes nearly impossible for asset-heavy businesses in an inflationary environment. To truly build a resilient portfolio, it's not enough to know what to look for. You must also be acutely aware of what to avoid. You must learn to identify the financial quicksand that traps and destroys investor capital during inflationary times. This is the inflation death trap, the world of capital-intensive businesses that lack pricing power. Warren Buffett's most formative and painful lesson in this area came not from a brilliant success, but from a dismal failure. It was his experience with the original business he controlled, the one that gave his legendary company its name, Berkshire Hathaway, the New England textile mill. When Buffett began buying shares of Berkshire in the early 1960s, it was a classic Benjamin Graham cigar butt investment. The company's stock was trading for less than the value of its working capital. On paper, it was incredibly cheap. Buffett saw an opportunity to buy $1 for 50 cents. He eventually took control of the company, intending to use its cash flow to invest in other businesses. But he quickly ran into a brutal economic reality he hadn't fully appreciated. The American textile industry was in a state of terminal decline. It was being relentlessly assaulted by low-cost foreign competition. Berkshire's only hope of survival was to stay on the cutting edge of technology, which meant constantly buying new, more efficient looms and spinning machines. The problem was that these machines were incredibly expensive. Every time the company managed to eke out a small profit, that money had to be immediately reinvested back into the business just to keep up. It was a capital expenditure treadmill running at full speed to nowhere. Buffett later described the situation with a poignant analogy. You have a business that earns a 10% return on the $1 million of capital invested in it. That's $100,000 in profit. But to stay competitive, you have to replace your machinery every year with a new model that also costs $1 million. So you take your $100,000 profit, and what do you do with it? You can't take it out. You have to put it back into the business just to buy the same number of machines as before, which now cost more due to inflation. You are running harder and harder, but you're not making any real progress. The business is consuming every dollar it generates. This experience with the textile mill was the crucible that forged his modern investment philosophy. It was a painful, multi-decade lesson in the difference between a cheap business and a good business. A cheap business is one whose price is low relative to its assets. A good business is one that generates high returns on the capital it employs. The textile mill had assets, but it generated no real return for its owners. The experience taught him that it's far better to pay a fair price for a wonderful business that gushes cash than to get a wonderful price on a fair business that consumes it. He learned that the combination of a capital-intensive business model and a lack of pricing power is a lethal cocktail for investors. Inflation only magnifies the poison. It drives up the cost of the new machinery, making the capital expenditure treadmill run even faster, ensuring that no matter how hard the business works, it can never truly get ahead. The eventual closure of the Berkshire Hathaway textile mills was an admission of defeat, but it was also the declaration of a new, more powerful investment paradigm that would guide him for the rest of his career. The reason so many investors, including the younger Warren Buffett, get caught in these capital-intensive traps is due to a powerful and persistent cognitive bias, the sunk cost fallacy. This is our irrational tendency to continue with an endeavor because we have already invested time, money, or effort into it, even when it becomes clear that the current costs outweigh the expected benefits. Our brains are wired to avoid admitting a loss. We don't want to accept that our past decisions were wrong, so we create a narrative of hope, convincing ourselves that if we just invest a little more, if we just hold on a little longer, things will turn around. Buffett's experience with the textile mill is a perfect illustration. For years, he continued to pour capital into modernizing the plants, trying to make them competitive. Each new investment made it harder to walk away. The money already spent became a psychological anchor, preventing him from making a rational decision based on the bleak future prospects of the industry. He was throwing good money after bad, a classic symptom of the sunk cost fallacy. Investors do this constantly with their losing stocks. They buy a company in a struggling, capital-intensive industry. The stock price falls. Instead of reevaluating their original thesis and admitting their mistake, they see the lower price as an opportunity to, quote, average down. They buy more shares, increasing their exposure to a failing business. Their logic is distorted by the initial investment. They tell themselves, I can't sell now, I'm down 50%. I just need it to get back to what I paid for it. They have anchored their decision-making to a historical price point that is completely irrelevant to the business's future prospects. The market doesn't care what you paid for a stock. Its future price will be determined by its future earnings power. The sunk cost fallacy turns investing from a forward-looking exercise in probabilistic thinking into a backward-looking exercise in emotional justification. It keeps investors chained to their mistakes, preventing them from reallocating their capital to more promising opportunities. To become a successful long-term investor, you must be ruthless in combating this bias. You must learn to evaluate every investment in your portfolio every single day, as if you were deciding to buy it for the first time. The money you've already invested is gone. It's a sunk cost. The only question that matters is, based on what I know today, is this the absolute best place for my capital to be for the future? This mental discipline is what separates the professionals from the amateurs and allows you to cut your losses on the capital-intensive losers and let your capital-light winners run. To help you avoid these investment traps, you can use a simple mental checklist I call the treadmill test. It's a series of questions designed to quickly identify the red flags of a capital-intensive business that is likely to perform poorly in an inflationary environment. Before you invest in any company, particularly in an industrial, manufacturing, or utility sector, run it through this test. Question 1. To grow its revenue by 10%, does the company need to significantly increase its physical assets? Look at the property, plant, and equipment (PP&E) line on its balance sheet. Has it been growing in lockstep with revenues? If so, this is a business that grows by building, not by leveraging its existing assets. This is a red flag. A software company, by contrast, can grow its revenue by 10% with almost zero increase in its physical assets. Question 2. Is the company in a highly competitive industry where price is the primary point of differentiation? Read the company's annual report. Do they talk about their brand, their proprietary technology, or their unique service? Or do they talk about being the low-cost provider and focus on operational efficiency? Language focused on cost is often a code word for a lack of pricing power. This is another red flag. Question 3. Does the company constantly talk about modernization, upgrading facilities, or fleet replacement as a core part of its business strategy? This language indicates that its capital expenditures are not discretionary growth investments, but non-negotiable maintenance expenses required just to stay in the game. It is a sign that the business is on a treadmill. This is a major red flag. Question 4. Is the depreciation charge a massive line item on the company's income statement? Depreciation is a non-cash charge that represents the using up of a company's assets. While it's an accounting fiction in any given year, over the long run it is a very real economic cost, because those assets will eventually have to be replaced. A large depreciation charge relative to earnings is a clear indicator of a highly capital-intensive business. This is another red flag. If a company answers yes to most or all of these questions, you are looking at a business that is highly likely to be a capital guzzler. It is a candidate for the too hard pile. The treadmill test provides a systematic way to enforce the discipline that Buffett learned through his painful experience with the textile mill. It helps you to identify and steer clear of the businesses that are most vulnerable to the ravages of inflation, preserving your capital for the truly exceptional opportunities. One of the most common mistakes investors make during periods of rising inflation is a behavior I call chasing cyclical hype. Frightened by the declining value of their cash and spooked by volatility in the broader stock market, they flee to what they perceive as the safety of real things. They see the price of oil, copper, or lumber soaring in the news, and they rush to buy the stocks of companies that produce these commodities. Their logic seems intuitive. If inflation is caused by rising commodity prices, then owning the producers of those commodities must be a good hedge. This is a dangerous and often value-destroying strategy. It mistakes a temporary, cyclical price spike for a sustainable, long-term business advantage. Commodity producers are the quintessential capital-intensive businesses with no pricing power. They are price takers, not price makers. The price of the oil or copper they sell is determined by the volatile swings of global supply and demand, forces that are completely outside of their control. Let's take a typical oil exploration and production company. The business model is a brutal treadmill. First, they must spend enormous sums of money on exploration, drilling wells in the hope of finding a new reserve. Many of these wells will come up dry, a complete write-off of the capital invested. When they do find oil, they must then spend even more money to develop the field and build the infrastructure to extract it. All of this requires a massive, ongoing stream of capital expenditures. Their profitability is entirely dependent on the market price of crude oil. When oil is at $100 a barrel, they are fantastically profitable. Their stock prices soar, and investors who chase the hype feel like geniuses. But commodity cycles are notoriously fickle. A small increase in global supply from another country, or a small decrease in global demand from a recession, can cause the price of oil to collapse back to $50 a barrel. When this happens, the oil companies' profits evaporate. They are now stuck with their high fixed costs and massive capital spending commitments. Their stock prices plummet, wiping out the gains of the investors who bought at the top of the cycle. The investor who chases cyclical hype is not investing, they are speculating. They are making a bet on the short-term direction of a commodity price, a notoriously unpredictable variable. They are failing to distinguish between a company that benefits from inflation because of its structural business characteristics, pricing power, capital-light model, and a company that simply has a temporarily high stock price because the commodity it sells is in a cyclical upswing. Buffett has famously said that the first rule of investing is to never lose money, and the second rule is to never forget the first rule. Chasing cyclical hype is one of the easiest ways to violate both rules. It lures you in with the promise of quick and easy profits, only to trap you in a capital-intensive, no-moat business, just as the cycle turns against you. True portfolio protection comes not from guessing the direction of commodity prices, but from owning the durable businesses that can prosper in any economic environment. To see the financial sleight of hand that traps investors in these capital-intensive businesses, you must learn to look beyond the headline number of net income and instead focus on Warren Buffett's preferred metric, owner earnings. Reported earnings, as calculated under generally accepted accounting principles, GAAP, can be highly misleading. For a capital-intensive business, net income often paints a picture of profitability that is far rosier than the economic reality. Buffett defined owner earnings as net income plus non-cash charges like depreciation and amortization minus the average annual amount of capitalized expenditures for property, plant, and equipment. In simpler terms, it's the cash that is actually available to the owners of the business after they have spent the money necessary to maintain their competitive position. Let's create a side-by-side comparison. We have two companies, software company, capital light, and industrial company, capital intensive. In a given year, both companies report the exact same net income of $100 million. An investor looking only at their PE ratios might conclude they are equally profitable and similarly valued. But now let's calculate their owner earnings. For software company, we start with its $100 million in net income. We look at its cash flow statement and see that its depreciation charge for the year was $10 million. This was the accounting charge for its servers and office equipment getting older. So we add that back. $100 million plus $10 million equals $110 million. Then we look at its capital expenditures. Because it's a software business, it only needed to spend $15 million on new servers to support its growth. So we subtract that. $110 million, $15 million equals $95 million. The owner earnings for software company are $95 million, very close to its reported net income. The reported profit is a good proxy for the real cash profit. Now let's do the same for Industrial Co. We start with its identical $100 million in net income. We look at its cash flow statement and see a massive depreciation charge of $80 million, representing the wear and tear on its giant factories and heavy machinery. We add that back. $100 million plus $80 million equals $180 million. But then we look at its capital expenditures. To stay competitive and replace its aging equipment, it had to spend a whopping $120 million in CapEx. We subtract that. $180 million. $120 million equals $60 million. The owner earnings for Industrial Company are only $60 million. Even though both companies reported the same net income of $100 million, the economic reality is that Software Company generated over 50% more cash for its owners. Industrial Company's reported earnings were largely an illusion, a phantom profit that had to be immediately reinvested back into the business, never to be seen by shareholders. This single distinction is one of the most important concepts in all of value investing. It allows you to pierce the veil of accounting and see the true cash-generating ability of a business. It reveals why a company with a low P/E ratio is often a value trap, and why a high-quality capital-light business can be a bargain even at what seems like a higher multiple. It is the financial tool that separates the inflation-proof winners from the inflation-doomed losers. Now we arrive at the final, crucial stage, synthesizing these principles into a modern, actionable playbook. How do we take Buffett's timeless wisdom and apply it to the investment landscape of the 21st century? The perfect case study for this is not a company from the 1970s, but one of the largest and most successful investments of Buffett's entire career, his multi-hundred-billion-dollar position in Apple. On the surface, Apple seems to violate the capital-light principle. It's a hardware company that manufactures and sells hundreds of millions of physical iPhones, iPads, and Macs every year. This seems far removed from the intangible nature of See's Candies or American Express. And indeed, for many years, Buffett and Munger avoided tech stocks precisely because they felt they were outside their circle of competence and involved rapidly changing technology that required constant reinvestment. But as Apple matured, Buffett began to see it not as a technology company, but as a consumer products company with one of the most powerful economic moats ever constructed. He looked past the physical iPhone and saw the true asset, the iOS ecosystem. He understood that once a customer buys an iPhone, they are not just buying a piece of hardware, they are buying into a seamless, interconnected world. They buy music and movies from iTunes, they download apps from the App Store, their photos are synced to iCloud, they communicate with friends and family through iMessage. They track their fitness with the Apple Watch. Each new product and service they adopt weaves them deeper into the ecosystem, dramatically increasing the cost and hassle of ever switching to a competitor like Android. This ecosystem is a profoundly capital-light asset. The cost to Apple for you to download one more app from the App Store is virtually zero. The cost to store one more photo in iCloud is minuscule. Yet these services generate tens of billions of dollars a year in high-margin, recurring revenue. Buffett saw that the true business of Apple wasn't just selling the first iPhone to a customer, it was selling the second, third, and fourth iPhone to that same customer for the rest of their life, while also selling them a continuous stream of high-margin digital services. This gave Apple incredible pricing power. It could raise the price of its new iPhone models each year, and its loyal customer base, locked into the ecosystem, would willingly pay. This combination of a powerful, capital-light digital ecosystem and the immense pricing power it created was a perfect match for Buffett's inflation-proof criteria. He recognized that Apple's brand was not just a brand, it was a utility. The iPhone had become an indispensable tool for modern life, something people would rather give up their car than live without. This is the ultimate form of pricing power. The investment in Apple demonstrates how Buffett's core principles are not static rules about specific industries, but a flexible, timeless framework for understanding business economics. He was able to look at the most valuable technology company in the world and see the same underlying characteristics that he saw in a small California candy company 50 years earlier. A beloved brand that creates a powerful bond with its customers, leading to a business that can generate extraordinary returns on capital with an inflation-protected stream of ever-growing profits. The ability to apply timeless principles to a changing world requires a constant battle against our own cognitive biases. When analyzing a company like Apple, most investors are swayed by two powerful mental shortcuts: confirmation bias and the availability heuristic. Confirmation bias is our tendency to search for, interpret, and favor information that confirms our pre-existing beliefs. For years, the prevailing belief about Warren Buffett was that he, quote, doesn't invest in tech. This became a mental model for how the world viewed him. So when he started buying Apple, many analysts and investors tried to find reasons why this was a mistake, an exception to the rule, or a sign that he had lost his touch. They were looking for information that confirmed their old narrative. A different kind of investor, the tech-focused growth investor, might have bought Apple for entirely different reasons, focusing on the potential of new products like a virtual reality headset or an Apple car. They were confirming their belief that Apple's value lay in future technological innovation. Buffett, however, was immune to these narratives. He didn't care about the tech label. He was searching for evidence that Apple fit his model of a wonderful business, and he found it in the brand loyalty, the switching costs, and the capital-light nature of the services division. He was searching for disconfirming evidence, reasons why it wasn't a good business, and couldn't find any that were compelling enough. The availability heuristic is our tendency to overestimate the importance of information that is recent, dramatic, and easily available to us. The media narrative around Apple is constantly focused on the next iPhone launch, the quarterly unit sales numbers, and the latest visionary product rumor. This is the information that is most available, so it's what most investors focus on. They are caught in the short-term news cycle. Buffett, in contrast, forces himself to ignore this noise. He is not interested in the quarterly sales figures. He is interested in the long-term, unchanging dynamics of the business. He is asking questions that don't make headlines. How many people will switch from iOS to Android in the next decade? How strong is the brand's connection with its customers? How much pricing power does the App Store have over developers? By deliberately focusing on the slow-moving structural variables, he avoids the emotional roller coaster driven by the availability heuristic. Mastering your own psychology is as important as mastering financial analysis. It requires the discipline to apply a consistent, rational framework to every investment decision, ignoring the popular narratives and the noise of the news cycle. It's about having the courage to think differently from the crowd and the patience to let your thesis play out over the long term. Now let's synthesize everything we've learned into a single, actionable tool, the inflation-proof scorecard. This is a mental model you can use to evaluate any potential investment, forcing you to analyze it through the lens of Buffett's core principles. It's a simple scoring system, from 1 to 10 on 5 key factors, where a higher score is better. Your goal is to only invest in companies that achieve an exceptionally high total score. The first factor is asterisk, trite tax pricing power. On a scale of 1 to 10, how would this business fare on the customer outrage test? A 1 would be a commodity airline that would face a customer revolt over a tiny price increase. A 10 would be a pharmaceutical company with a patent on a life-saving drug that could charge almost anything it wanted. Score the company based on the strength of its brand, switching costs, and network effects. The second factor is asterisk top capital lightness. On a scale of 1 to 10, how efficient is this company at growing? A 1 would be a steel mill that has a growth-to-capex ratio of less than 1, meaning it must spend more than $1 in assets to generate $1 in new revenue. A 10 would be a software-as-a-service SaaS company that can add a new customer for virtually zero marginal cost. Use the growth-to-capex ratio as your primary guide here. The third factor is asterisk treadmill risk asterisk, which you will score inversely. A company that gets a 10 on this factor has very low risk, while a 1 has very high risk. How many red flags does the company raise on the treadmill test? A company that must constantly modernize and has massive depreciation charges gets a low score. A company with few tangible assets and low maintenance needs gets a high score. The fourth factor is the strength of its asterisk intangible assets. On a scale of 1 to 10, how powerful is the company's non-physical moat? A 1 is a company with no recognizable brand and no proprietary technology. A 10 is a company like Google, with a globally dominant brand, a network effect in its search data, and proprietary algorithms. This is a qualitative judgment on the durability of its competitive advantage. The final factor is asterisk time owner earnings quality. On a scale of 1 to 10, how closely do reported earnings track real cash earnings? A 1 would be our industrial company from the earlier example, where owner earnings were a fraction of net income. A 10 would be our software company, where the two numbers were nearly identical. This score measures the honesty of the company's reported profits. After scoring a company on all 5 factors, add up the total. A perfect score is 50. A truly wonderful inflation-proof business will likely score above 40. A mediocre business will be in the 20s. A capital-intensive value trap will be in the teens or lower. This scorecard is not a magic formula, but it is a powerful discipline. It forces you to look beyond the stock price and analyze the fundamental, long-term economic characteristics of a business. It is your personal playbook for executing a Buffett-style investment strategy. The final obstacle to implementing this strategy is the seductive simplicity of the most common advice in modern personal finance. Just buy the index fund. For many people, investing in a low-cost S&P 500 index fund is a vast improvement over holding cash or trying to day trade individual stocks. It provides diversification and captures the overall growth of the market. However, in a high-inflation environment, this path of the 99% becomes a strategy for guaranteed mediocrity, not for superior wealth preservation. An index fund, by its very definition, is an instrument of averaging. When you buy an S&P 500 index fund, you are not just buying the Apples and Microsofts of the world. You are also forced to buy the struggling capital-intensive airlines, the low-margin industrial manufacturers, and the heavily regulated utility companies. You are deliberately choosing to dilute your holdings in the wonderful, inflation-proof businesses by also owning the very businesses that are most vulnerable to inflation's destructive effects. Think of it like building a basketball team. The Buffett approach is to carefully select only the superstars, the players who are dominant in every aspect of the game. The index fund approach is to buy the entire league. You get Michael Jordan, but you are also forced to have the last player on the bench of the worst team on your roster. While the overall team might be decent, its potential is capped by the dead weight you are forced to carry. During a period of rising inflation, this dead weight becomes an anchor. The capital-intensive losers in the index see their margins crushed and their earnings collapse. Their poor performance acts as a drag on the entire portfolio, offsetting the strong performance of the capital-light winners. You are essentially running in place, with the good companies pulling you forward while the bad companies pull you back. Opting for an index fund is a passive admission that you cannot, or will not, make the effort to distinguish between a good business and a bad one. While this is a humble and often sensible approach, it is a suboptimal strategy for an investor who has taken the time to understand the principles we've discussed today. It is a choice to accept the average return, which, after being taxed by inflation, may be insufficient to achieve true, long-term financial freedom. The path to building a truly inflation-proof portfolio requires a more deliberate, more concentrated approach. It requires the courage to deviate from the average and to make a conscious choice to own only the best. Ultimately, the goal of any coherent investment strategy is not just to achieve a nominal return, but to achieve a real, after-inflation return that meaningfully increases your purchasing power over time. The choices you make, to hold cash, to buy an index, or to build a concentrated portfolio of wonderful businesses, will have profoundly different outcomes over the long term. Let's project this forward over a 30-year investment horizon, the typical time frame for someone saving for retirement. Imagine again our three investors, each starting with $100,000 in a world with an average annual inflation rate of 4%. Our cash hoarder, earning 1% in a savings account, sees their nominal balance grow, but their real, inflation-adjusted purchasing power is destroyed. After 30 years of a negative 3% real return, their initial $100,000 in purchasing power will have shrunk to just over $40,000. They have worked their entire life to save, only to have lost 60% of their wealth. Our index fund investor fares much better. They earn a nominal return of 8% per year. After subtracting the 4% inflation tax, their real return is 4%. Compounded over 30 years, their initial $100,000 in purchasing power will grow to approximately $324,000. This is a successful outcome, one that will likely afford them a comfortable retirement. This is the mainstream definition of financial success. But now consider our Buffett-style investor. They have carefully constructed a portfolio of capital-light businesses with strong pricing power. Their portfolio also earns a nominal return of 8% from market appreciation, but their underlying businesses are able to grow their earnings by an additional 4% each year to match inflation. Their total nominal return is 12%. After subtracting the 4% inflation tax, their real return is a powerful 8% per year. What does this difference mean over 30 years? An 8% real return, compounded for 30 years, will turn their initial $100,000 in purchasing power into over $1 million. Look at those final numbers. $40,000, $324,000, $1 million. The difference is not just a matter of degree, it is a difference in destiny. It is the difference between a retirement of financial anxiety, a retirement of comfort, and a retirement of true financial freedom, and the ability to create generational wealth. This is the direct financial connection. The principles we have discussed today are not academic theories, they are the engine of this outcome. The ability to identify pricing power and capital-light business models is the skill that allows you to move from the path of the 99% to the path of the 1%. It is the intellectual framework that transforms investing from a game of chance and speculation into a disciplined process of acquiring partial ownership in the world's most resilient and profitable enterprises. This is the ultimate defense against the invisible thief of inflation and the surest path to securing your financial future. You have just invested a significant amount of your most valuable asset, your time, to download a new and powerful piece of software into your mind. You have moved beyond the simplistic and flawed advice that dominates personal finance and have acquired the foundational principles of an investment philosophy that has been proven to work over decades of turmoil and uncertainty. You now understand that inflation is not a passive force to be endured, but an active threat to be defeated. You possess the mental models, the customer outrage test, the growth to capex ratio, the treadmill test, and the concept of owner earnings, to dissect and analyze a business at a level that few investors ever reach. You now know how to identify the two critical DNA markers of an inflation-proof business, pricing power and a capital-light structure. This is a profound advantage. You are now equipped to protect your wealth and grow it in real terms, to move from being a victim of the economy to being its master. But what we have assembled here today is just one critical piece of a much larger interconnected system. Warren Buffett's mind is not a collection of isolated tricks. It is a latticework of mental models, where each principle supports and enhances the others. You have just forged a powerful key, but it only unlocks one room in the castle. The framework for identifying inflation-proof businesses is made exponentially more powerful when it is combined with the principles of behavioral finance that allow you to act rationally when others are panicking, and the valuation techniques that ensure you never overpay for even the most wonderful business. Each model is a link in a chain, and the strength of the chain is determined by its weakest link. Mastering one is a monumental step, but true mastery comes from understanding the complete system. The journey of intellectual compounding does not end here. In fact, it is just beginning. The video that is now appearing on your screen is not a random suggestion from an algorithm. It is the next piece of the map. It is the missing link that connects the principles of business analysis you've just learned to the next critical domain of the Buffett philosophy. It could be the psychological framework for controlling fear and greed, or the quantitative discipline for calculating intrinsic value. You don't know which piece of the puzzle it is yet, but it is the one you need next. The decision to click is not about watching another video. It is a choice about who you want to become. Are you a person who gathers isolated facts, or are you a person who builds a complete, cohesive mental arsenal? Are you content with knowing one part of the system? Or are you driven to understand the whole? The path of continuous learning is a steep one, but it is the only path that leads to the summit. Complete your arsenal. Continue the ascent. Click and master the next piece of the puzzle.